All right, welcome back, everyone. It is Friday. We're going to deal with our fractional real estate. So we got Joseph Cachapalia back. So welcome, Joseph.
Hey, how you doing, Mark?
Good, good. So we are expecting a guest. Maybe they're having technical difficulties, but Joseph is checking on that individual. But I think the fractional space is picking up quite a bit. Like we mentioned, Zuber kind of touched on it, had a guest on talking about fractional real estate. And I think you really enjoy that. You see that this space is kind of growing. So, what was your take on Zuber's interview? Maybe.
So that's a company that I've covered a couple times. I think they're very much just there's this whole group of fractional real estate companies that I just refer to as the arrived clones because they're like basically copying arrived homes exactly. It's a model that just has so much cost and fees built into it that it's hard to imagine you'll make money investing in them in their current iteration. Um, so I don't know. I'm really glad to see more people talking about the space. I actually have talked to some of the guys at Real Bricks. That's the company who was there, who he talked to, and I think they understand they need a little bit of a change in model, but they also understand there's such a demand for fractional real estate where people can just get this, small real estate exposure that people they're selling stuff regardless of how good that deal is. um Alec did just mention that he's gonna be on in a minute. um I don't have a great track record getting guests on here that want to show up on time. I'm not really sure what that is. I don't know if I don't do a good job communicating that what we're doing, or if it has something to do with our space in general. We're very um I don't know. He actually is a super comes across as extremely professional guy though. But I think in general our space is full of people that don't want to be, tied to a schedule or, really having to do anything in real life at any specific time.
Well, that is one of your big attractions to it, right?
Exactly, exactly. So that's I guess it's somewhat understandable.
Yeah.
Um I'm gonna just tell you a little bit about him before
Yeah.
he gets on, since we know he is coming on here. So Alec, most people, if you've been in our Discord on the Lofty Discord, you know him as Whalick, because he's a whale and his name's Alec. He's been an investor on the platform. He's brought properties to the platform as a co-owner, so he's taken his properties and brought them on. My cat always wants to be on these live streams. And then uh, he started a property management company, specifically to manage properties that are listed on Lofty, and I think probably manages 40 to 50 units on there. I think he's going to have a lot of good stories for us. Hopefully he can give us some inside insight. But it's been interesting. So one of the things that I think, and I'm going to ask him about it. Hopefully this is not putting him on the spot too much. One of the things that's interesting in this space is because it's all on blockchain, everybody, you can pretty much figure out who owns what and how they're doing. So I think he's had a rough go of it on the investor side. So I want to ask him some about that. Um, but just in general, I think he's just going to be able to give us a lot of insight into what it's like to bring a property to Lofty, what it's like to try to deal with them when you're managing properties for the platform. Um, and anything else. I got quite a few questions from our community in the Discord to ask him, but definitely if anybody else has them, send them our way as well.
Well, we do have a question. I see Roger tuning in from your channel. It says, "I have 4 cats. Is that your only one?"
That's my only cat. Yes.
I have. I don't have 2 cats. Well, my son's mom has the cat, so she has the dog and the 2 cats now. But yeah, I like cats. Cats are actually pretty cool. But yeah, there's a lot of people tuning in from the one rental at a time community. So hopefully, a lot of them did tune into Zuber's interview with Real Bricks, talking about fractional real estate. And the interesting thing was, if you did go back, so I have a weekly thing with Zuber. We go through the comment section, kind of deal with the spicy ones and questions people have. But
Hmm.
when I went through that video that he did, there was actually a lot of people commenting about fractional real estate.
Oh, interesting.
Punakar, who's one of the frequent commenters on Zuber's channel and appears to have a very successful portfolio, but he was mentioning that, yeah, I think he has the same feeling as you, where he feels a lot of people, fractional real estate is a great place for them to start and get involved. And he feels a lot of people should be kind of in that space initially if they're going into real estate.
Yeah, I mean that's been my stance. It is talking to Dion was kind of interesting the other day about it, right? And I think that he made a good point about there's the risk of like people really being turned off by bad platforms. And it is like, for some reason, it seems like the worse a platform is, the more attention it gets, right? Like it seems like either they just, all the ones that have like what I think of as very subpar deals are the ones that I see all over the place. And I don't know if it's just like they've just focused on marketing to investors that don't really, they're just marketing really hard to investors because they know their deals aren't going to do it for them. And so I end up seeing them a lot, or what it is. But yeah, I mean, I think there's so much potential in the space, but certainly a lot of risk of just getting some duds early on, because there are so many of these platforms that are just like, one of the ways you can really tell is they talk about things like, oh, build generational wealth, get some equity. They don't ever talk about actual returns, right? They're like, they use a lot of the buzzwords that make you interested in real estate, but aren't actually like giving you any real meat on what it is that you're getting from them. Or sometimes when they do give you that, it's just completely not, doesn't line up with what you see on their website, which is I don't know. I did a little reaction video to that video, because one of the things in his interview, the Real Bricks guy said they buy 8 caps, and I don't know where they're putting them because they're not on their website. So I thought that was pretty interesting.
Yeah. What was your takeaway having Dion on? We kind of brought Dion, the lazy investor, who was the keynote speaker at Bigger Pockets, and I think he had some good discussion on fractional real estate and the platforms and whatnot. So, what was your takeaway on that little additional stuff?
Yeah, no, I mean, I think so. I like him a lot. I think that me and him think about the world in very similar ways. Um, and I think he made some good points about one of the things, as far as like, if investing in fractional real estate is going to delay you buying properties in real life, and that's your end goal, um, it's probably not a great idea. But I think it, provided your timing is right in the way that you're investing in these deals, it can be a way to get your first property quicker versus, because your money doesn't have to be locked up in all these platforms. Some of them it's very short term, and you can just be turning over your money, learning a little bit about real estate as you're saving for that first down payment.
I see Everyday Finance tuning in from your channel. He says, "Howdy." He says, "Where's Alec?"
Not sure. He said he should be here in a minute. That was a few minutes ago, though. So,
Yeah, so he'll be jumping on soon. We're just kind of wrapping up Joseph's kind of recent videos he has on his channel. Michael Zuber, One Rental at a Time, has done some interview with Real Bricks. So fractional real estate is getting out there. And just to remind everyone, Joseph does have a YouTube channel. It's in the chat. Also, he's also pretty prominent on X. So go check him out there. And I believe our guest is here. So hold on, let me bring him in.
Hello.
There we
hey,
go.
Alec.
Hello, everyone. Sorry, little camera issue getting started here.
No, morning. Welcome. So welcome back. If people don't remember, Alec, maybe a couple months ago, jumped on with us. But quickly, Alec, I know Joseph kind of touched on it, but maybe remind my audience who you are and what space are you kind of in.
Yeah. Thank you again for having me back. Sorry for the slight tardiness. But yeah, basically just a real estate investor, but also in the fractional space, involved with Lofty.ai. Just enables people to buy tokens of various properties, and so heavily involved in there, both managing at this point as well as actually doing, actually investing my own money as well.
So I got a bunch of questions from other people in the Discord. I asked them to just send DMs.
Yeah.
One of the things that's interesting is, this our wallets are all pretty much, people know who owns what on the platforms, right?
Yep.
So I don't know if some of them are things that you don't really want to talk about because they're like about how you're specifically doing. Just let me know. We don't have to do that. But that we got some interesting characters asking questions. So I'm going to start though. Were you a real estate investor, or the co-ownership properties you had brought on early on, Andover and Loudoun, were those your first two investment properties?
Loudon was my first, and I have a few that are not, like a number that are not on Lofty, just either because there was, there wasn't really a good fit, or had other plans for him. But Loudon was my first investment property.
And so those, and I think you brought a third on as well, right?
Cedarwood, yeah.
Have those all been? Do you pay for the mortgage on all of those, or not on the most recent one?
I pay for the mortgage on all of them right now.
All of them.
In discussions on that, because many people are moving a lot of their mortgages over the DAOs as I think things kind of stabilize and whatnot. Yeah, I mean, it's kind of an interesting little transition in the Lofty space right now.
And that's what we had. Just a bunch of people have questions about, like, if you're, because I don't know if you remember, but it's something I've been critical of basically since the first day I got on Lofty. I thought that the co-ownership model where you guys pay the mortgage outside of the DAO structure has never made a ton of sense, right? It makes it so, yeah, you can get fantastic yields as an investor, but it never looked sustainable to me, and it seems like that's pretty much been proven a few times now. If you had it to do over, would you still have brought properties to the platform that you had to pay the mortgage, or no?
Well, I mean, that's to be determined. I guess I'm about a year and a half in.
Yeah.
Or probably more than, I guess a little bit more than that at this point. And I'm seeing the weakness in it between, recent bankruptcies and just more and more. I see more and more people that kind of like put the property on, and I think it was always maybe the intention to move it over, and that wasn't really mine. But then I also got put in a position of like fronting a bunch of bills for properties, and generally, I mean, from at least from my perspective, and I heard the Lofty team say this too, that like I'm really trying to help their platform and everything. So I feel like I attempted to play by the rules, and like some people just don't seem to be. So I feel like that's kind of where it is. So now I'm reshaping the mindset. But the thing is, in my mind, when I look back at it, like I maybe had a different reason for when everyone was grilling me at the start when I was first starting as a co-owner, saying like, it's kind of a way of getting a HELOC. It's sort of a way of pushing things back, like taking the long-term play of hanging on to the loan, because like I had a 3.99% loan on Loudon. That was my idea, and I could get some of the equity out that remained in there and also put it towards other investments or bring on more properties. And I haven't fully brought that to fruition yet, just with everything else that needs to be stabilized, but I still think that's kind of the idea down the line. It's just there's so many bills now. So now I'm reconsidering or thinking also the DAO is stronger if it's able to cover its debt service, because like if there is someone that defaults or there is someone that goes into bankruptcy, as long as the property's cash flowing, which both Loudon and Andover are cash flowing. I think Cedarwood's very close. It might be slightly cash flow negative, but that might be able to change going into January with like a rent raise. I think it would switch it over from being slightly negative to slightly positive. So that was always kind of the idea. It was like rents keep going up, things keep pacing up, and overall in the long run, it was like you'd hang on to the debt and it'd become a better and better deal. But you need to have a investment time horizon of 10 years, 15 years to see that to fruition, rather than just a year or two. So
And you have to have a way to continue to pay that debt as you scale, right? Like that's what seems broken about it to me. Like you're not, it's, unless you're just holding enough of that property where you're able to pay it from the rents, you either just need outside income, or we're going to see like what we saw with Brownfield, and what it looks like, we're starting to see with some other ones as well, where they're just saying, hey, I want to scale, I can't do it because I'm paying this debt.
yeah, I would tend to agree with that. Again, I felt as though that I when I brought something to the platform, like I disclosed as much as I can the things that would
Right.
go wrong. I even offered credits on stuff, and I feel like other people came and they saw an opportunity to do that. So I guess in my favor, hopefully it built trust with investors, because at the very start, I can remember back even when Cal was getting on or other people were getting on, I was like, these people aren't sharing 90% of the information. And I would ask questions, and people would say, they would say things like Cal would, he would actually tell me like, stop asking questions. And
Right.
so
Right. That
like,
was a big red flag for him early. Like I had the same experience with him for sure.
so
Um,
like, could it be sustainable for me? Yeah, but like, wrapping it up to the people that want to hold long term and aren't just return chasing,
mhm.
I think it's a good long term move. But um I again would more or less be happy with keeping it. It's just the same deal. Like if something ever happens, like it leaves you dependent to my financial situation. And
Right.
after seeing what happened with Austin, barring Lofty forcing people to give up their personal financial information, which a lot of people probably don't, and I don't even know if I fully want to give up my full financial information just for
Right.
investing in the platform, or at least everything about my financial situation. Uh, that's necessarily the best indicator. Now they do credit score and other stuff like that. They have some indication, but people get private loans, people have other obligations that are in there. So I mean, you're sort of at it's a double-edged sword. It's very unregulated. It's very flexible, but now we're seeing the downsides of that too. It's not all one-sided.
Yeah, and that's what I've thought this, and I've said it probably I don't know tons of times on different videos, but um, you're like you said, we're completely dependent on that co-owner if we need, if they've committed to paying paying the debt or paying credit, and yeah, we just hardly ever get any sort of real info. Like when Brownfield first launched, I was asking a bunch of questions on like how is he paying that debt? This makes absolutely no sense to me. And the response I got from a bunch of people were, he's a millionaire. He's got a bunch of properties. Clearly he's going to be able to, and I'm just like, that's just a non-answer. But so I don't know. I will say, I want to mention, I'm asking you these questions, but I think I'm invested in Andover. It's one of the few co-ownership properties I own. I own a couple of yours. I do own a couple of REOs. A little nervous with some of the discussion going on there.
Another
And
person looking to move payments over too. It's
yes,
coincidentally,
yep.
yeah.
And some of Earl's, but like one of the reasons that I've been in Andover and it was never planning to sell it is because it's very obvious that you were someone who was trying to protect investors and build a relationship. Like, I mean, I feel like maybe there was like a stove that had to be replaced, and you're like, I'm just covering that. Like, I mean, there was something that it was just like, okay, he's not just trying to squeeze every dollar out of the Dow. He's like trying to create a long-term investor relationship, build some trust. So definitely from that perspective, like I think it would be a good model if if it wasn't so attractive to bad actors, right? If it wasn't something that was just like just it's just way too easy to sell a chunk of equity and then be like, especially on the ones where they're not, they really haven't personally signed on the debt for some reason, right? I mean, those are the ones I think that are, because they bought it subject to and then bring it to the platform. And so,
Yeah.
some of that stuff is what really scares me.
Well, I mean, in the case of like Austin and stuff, or other properties that had private loans, sometimes you can't even find the lender. You can't even find their
Right.
contact information. So I had to hunt that down for various properties that I had to step in for. At least with mine, like you have the full loan documents, right?
Right.
Like you know that my loan is with Movement Mortgage on one or Mr. Cooper on the other, and you can see the loan statements. You have someone to contact to. You have some actual record, and not to hate on private loans. I just think as a platform, they need to sort of be covering that more and having more emphasis on, I don't know, either asking people up front for it or holding more accountability.
Right.
Um, especially for people that just like bring a single property where if that's one of the only things they need to focus on, that's all they needed. So, because I'm going to say I'm fully guilty of that too the past couple of months, just by the sheer volume of work and trying to keep up with everything across everything I'm managing now. And I'm pushing to get to a better and better spot and be more and more transparent and provide regular reporting to everybody to try and help with that, so people can see like, oh, this this water heater broke, or this air conditioner needed servicing or something like that. Whereas other people just won't even do that altogether, or they just wouldn't provide any financials. And then there was a whole discussion today about this morning in the Discord about that too with Jerry. So
I do want to I want to ask you a little bit about what your experience managing some of these properties. But before that, because of you mentioned about the private lenders and that sort of thing, it made me, this was another question I had for the Cal properties in Florida, his co-ownership properties. There was had quite a few discussions early before before you took those over, with a few people about like just how much control him just being in control of the debt gives him, and how hard it was going to be to actually like try to wrestle those properties from them. I didn't ever talk to you about it, and I didn't know. And in retrospect, I should have probably reached out to you and talked to you. I was still early in really putting myself in some of these problems at that point. But if you had that to do again, would you have just left those properties alone? I mean, it seemed like he just had such a. It seemed like just having control of, even though it's his debt, right? Like you'd think like that doesn't give you any power, but it really kind of did, right? Like it kept him from getting in trouble when he was when he was there when he maybe shouldn't have been, and all that sort of thing. Yeah, any good lessons learned out of that?
Oh, absolutely. Yeah. To answer your question, yeah, I'm not really trying to even attempt to manage them. I did my part on there. And it just effectively, it's a weak point in real estate. And it's something to think about if you ever get into any real estate transaction with partners, that if two people own a home, and like what you want to have someone over that the other person doesn't like, well, if you're both owners, you can't have them leave. You can't tell that person to leave. If your name's
Right.
both on the title, it's not there. So imagine 1,000 people being on the title.
Yep.
Now, the crazy and interesting part is, if all 1,000 owners showed up and could prove ownership, the police would probably just say it's a civil matter, can't do anything, and everyone could stay there, or everyone could do something with the property. So that was what I quickly ran into dealing with it. There's at this point the cops were called twice. They just immediately throw their hands up and say it's a civil matter. And yeah, I mean, if I had known that, I think the aggravating one was really the second time, where he had nothing. He didn't even own any of the property. He just had his name on the debt.
Right.
And the cop said, I don't know real estate law, so just go ahead. And
Yeah.
we have him recorded ripping down the cameras, and basically just taking the property right back. There's nothing I could do. They didn't even acknowledge the lease in place, which is crazy. You think the cop would have asked, like, is the property currently rented, or is there a legal lease in place?
Right.
They just didn't matter.
Just want to quickly say good morning to a lot of people tuning in from Joseph's channel, looks like. So, like I said, we got Everyday Finance. We got Investment KD. He said second listener, first time getting to the live. Investment KD also said the velocity that Austin took on properties was scary.
That's true. That is Very. I think he said he doubled his business every 2 years, and now I think he's undoing it all very quickly.
It
We
does
got
seem like it's coming apart, maybe even faster than that. So,
Oh yeah.
you know.
we have Roman Fox who says, "This is Scout. My YouTube tag is different." And we got Harrison, Trade Better 99 says, "Good morning from Virginia. Just want to pop in quickly to say hi. Joseph, let me know if you are still interested in the property you posted on. I may be able to check it out."
I'm not sure which property that is. I probably
All right, Harrison, if you can, if you're still here, or you can message Joseph in school or on X.
property I posted.
Yeah, let's see.
Interesting.
We got M1 Homes tuning in from Joseph's channel.
Nice.
Thanks for stopping by. A lot of people coming from your channel.
So M1 might be our guest sometime in the future. So
all right, M1, you heard that.
Oh.
You can
Never
jump
seen what he
on with
looked
us.
like.
Yeah, well, so
right.
Lord Slade 1 says, "Alec, good to put a face and voice to you, man."
Thank you.
And here's a question from Investment KD. Says, "What has been the evolution of experience in real estate? What's to be learned? Lesson, key takeaways, and analysis and structuring deals."
That's a question for you, Alec. You're our
Oh,
guest.
okay. Well, I think we've gotten into some of them. Is one due diligence. I think on the fractional space as a whole, due diligence is probably lacking. So even though I think your video, like even on the Cedarwood video, is a little bit critical, I appreciated it because you actually went through and just picked apart everything on the property, which is good. I mean, that's what investors should do. And again, I think and I'm guilty of it too, of just like getting sucked into return chasing, and we're even seeing that like maybe the returns are not truly as high as they make them out to be. And if there's some way that could be incorporated, I think if the real return was better calculated for a number of properties, or the way you counted in your actual due diligence for investing, there'd be a totally different case. And I think that's probably one of Lofty's weakest points, is that it's relying off of leveraged returns. It's relying off of perfect scenario. It's relying off of all these things, the update on a monthly basis, which can't really reflect the day to day as well. And it's difficult as a platform, being like an active platform versus passive investing in a REIT, where it's just kind of you throw your money at it and what happens is what happens. Whereas the whole design on Lofty is you're supposed to be actively involved. And we see that there's people that are not always necessarily looking for that. They're just looking to sit back and, get their return and check out. And that's fine. But I mean, I just don't think it's fully what it's designed for. And it's also what gives Lofty the legal standing to do what they're doing anyways, as far as regulation.
Yeah, I mean, one of the things I say this quite a bit, but they're on their platform. We're both the customer and we're the product, right? Like how well that property performs depends on us, the customers, what we're doing with it. So it's a really weird spot to be in. I think that if they ever can make it actually work well, that it is a great, when they're like, we're just a platform, we only want to, help the trades happen and basically nothing else, seems like their current position. Like, yeah, that's a fantastic spot for them to be in. But without just like people like you and Earl and M1 and a few other people, like they're really just counting on other people to make their platform work for them, which is, kind of, it's going to be interesting because it's like, whenever I see all the work you're doing and the money you're putting into other people's deals, and other people as well, I really question, like, I mean, obviously you think this is the best use of your time, but it seems like you could just go out there and crush it in real estate in general, and not just be sort of building this thing. Like between you, Earl, and M1, you're building Lofty for them, like, and it's sometimes it's hard to see like why, three younger, smart, like, entrepreneurial people would want to do that, when a lot of the benefit is accruing to someone other than you.
Yeah, I agree, and I've reconsidered that over the past, probably the past year, and with everything that's gone on. I mean, there's a little bit more benefit for me, like being able to manage and sort of build some more business side out of that. So I have gotten better experience with that, and like building credit lines, being able to have a separate source of income coming in from there. But yeah, I mean, I have reconsidered that, and I think that's sort of why there's been a move towards, I mean, for myself at least, to try and sell some of the underperforming places, because
Mhm.
I think they're just not worth the hassle of the time. And I think that's why the old PMs were fine with it, because they were getting paid like, maybe less money, but they just didn't do anything at all.
Right.
And they would just let it sit there. And if it rented, that's great. Even if it didn't, it didn't. And yeah, I mean, I think my onboarding was aggressive. But
Yeah. How
I
many
think
properties are you managing now? You took over quite a few in a short period of time.
we peaked at about 60, and I think it's dropped back down to like mid 50s. I think a
Through,
couple of them I
through
moved to
sales
Earl.
mostly?
There will be more sales, but right now it was just I changed management, a few of them over to Earl, and I
Okay.
also yeah, there a couple sales have gone through or about to go through, so that will be good. And I mean, this is stuff that's just vacant, or it's in, like, I'm talking with the agents and they're like, this is just not a good area, or like it's a property where we've been trying to fill the vacancy, and I just think they're, from what I can see, I mean, I follow the real estate market too, and rates and the Fed and everything. It just seems like we're in this environment where like certain markets are just suffering way more than others. Some places like in the Northeast are still appreciating. Some markets are going down a bit, and the rental markets are adjusting accordingly too. Like, it was red hot here. Took me 3 months to fill my own property, that I go out and I inspect in person, so the condition of it. And granted, I finally was able to, like, basically, hopefully, fingers crossed, sign someone today. But that last year might have been a different game. Like, I might have filled it. I think the vacancy that I filled from there was like nearly instant. I already had someone in. We didn't even lose a day's worth of rent because I already had someone lined up ready to go. So it's or a couple weeks to fill it. So I think we're seeing that all over, that variation by market. And that's I guess the thing that people miss. They look at real estate as like the same through everywhere.
Like
They're
it's
like
one market, like
yeah,
it's
the
the real
national.
estate
They look
market.
at the national numbers, and the national numbers apply to everywhere. But every zip code is different. Every zip code, like the zip code that I went to high school in, didn't even go down in 0809. It actually continued to just level off and go up.
Mhm.
And there's other zip codes that lost 50%. And it was during the exact same time period. So it's not always that simple in real estate. It's actually much more micro than
Right.
people want to
I think
do.
a lot of people like know that markets matter, but they don't really learn that markets matter until we have a downturn. Like, while things are doing well, like, you can invest in a lot of these like secondary, tertiary markets. Everybody's doing fine. And then, but when there's a pullback, there's a reason that those safer markets are actually safer markets. So I think that's, yeah, we're definitely, I mean, obviously all the stuff that got sold onto the Lofty platform the first couple of years were, in markets that nobody should, I mean, not as bad as Pittsburgh or something, but
Hey, come on now.
that's Mark invests there. I
Yeah.
like,
But just to clarify, Sir Harrison I think he was telling you Joseph Petersburg. I don't know if there's a property.
St. Petersburg.
Yeah.
yeah, that's one of the properties on Mogul. I am planning on buying a piece of that today. I'm just waiting for my money to move from one account to the one that I buy out of.
So yeah, I guess if you want, Harrison said he can check it out for you if you
I
want.
mean,
But
that would be awesome. It'd be interesting to see. So uh, we haven't had a ton of like. There's actually one guy who stayed in some of the uh, Airbnbs on some of the platforms, but we don't always get it like a good drive by or anything from any of them. So that'd be fantastic.
um, Aximus says I'll watch quietly this week, and he says I like Alec. Okay.
Thank
Um,
you.
so Charles McCune is here. He says, "What is the average to putting a property in fractional?" Hmm.
advantage maybe.
Could be. Maybe you can
What
roll.
is the
Yeah,
advantage?
maybe. Yeah.
Yeah. So what do you? I mean, what do you think the biggest is? Like, what made you want to do it? What was the biggest advantage for that? Was it just access to capital or something else?
It was that. It was also, I have friends that are, they'll hear stuff about the real estate market and they'll be like, yeah, I totally would love to invest with you. And I never really had a good way to be like, sign off on this legal agreement or something.
Right.
Because I always like to put as many things into writing as possible, just because I just don't like the handshake deal mentality.
Mm-hmm.
Because it leads to situations that we're kind of in right now, and some of these things. So being able to write up something like that just is very time consuming, and then like people have to lock away their money. I really do love Lofty's ability to like allow quick liquidity, allow people to get in and out of things,
Yep.
and the leveraged returns. Like I understand why people like that, because if you can make back your fees really quickly, you can, if something is to occur and you want to be more of a trader, you can actually navigate the market. There's people that do that. There's people on there. I always joke and say that Kyle Lease is he's the guy with the pink flamingo thing, is
Mm-hmm.
like the best trader on there, because he always makes out way better than me, or I'm his exit liquidity or something. So it's a play that I should probably take advantage more than I do. And that's like an opportunity. But to answer the question is, I wanted a way to just have people say, hey, like I can just put in $50 and like invest with you, and actually I can own part of Loudon with you. Because that was a property that I started telling people about when I got started, and it's overall a very solid property, and it's a great way for people to kind of immerse themselves without going too much, because as many real estate investors know, it's a very capital intensive investment. Can be very expensive. Repairs can be very expensive. So it's just like a great way to immerse yourself and learn about real estate, which I have through there too. Um, and I'll easily allow people to get in. Just give them that, or I'll wear the Lofty hoodie that I have around somewhere, and people will ask about the QR code on there. It's a great way, a great, nice little conversation starter. So people that are actually serious, you can have them sign up that right away. And it's the other kind of great thing is like, since everyone's actually an owner, from like a rental standpoint and stuff, that really helps out too. If like I don't know, you need to do something related to evictions or lease signing and all that. So those are all like nice little perks. I mean, to counter the stuff related to Cal, I think it's actually one of the really big upsides when you use it to the right side. So there's definitely big advantages. I mean, also I think the liability advantage is huge. I can't tell you how many tenants are like, who's the owner of this property? I'm like, even if I wanted to tell you, I couldn't, because there's 150 people own this property. So it's funny that some of the stuff that people, like some of the tenants, have come to believe, or like I don't even know how to explain, but I know that some people have said, like, if you list your properties, like I didn't tell my tenants that I was going to be doing it, but it'd be interesting to see some of the reactions, or how people would feel if like 1,000 people owned the home that they were renting in, or something like that.
Lord Slade 1 says, for my part, I will not put a penny into any property that isn't managed by Alec Earl M1. The risk is too great otherwise.
Yeah, I would probably tend to agree. I mean, I think Ario's kind of overlooked. I think I know you think I'm very aggressive, Joe. I'm trying to tone that back for sure. Especially, and again, I'm concerned, like recession concerns, being caught without reserves during downturns. So I'm definitely keeping that in mind, especially with everything going on this year, rate cuts, job markets looking like softening right now.
And I'm sure you've learned like a really hard lesson by investing in, you had a big
Yeah.
chunk in Austin's deals.
Oh
And,
yeah. Oh yeah.
I mean,
I'm toning it way back on any co-ownerships, and have to really, really, really like I was too lenient on him with what I did, and I'm not trying to place the blame on him. People want to. I want to keep the responsibility on me because it was ultimately me that offered to give the money over. People are mad about the rent credit and everything else, but it was still on me to ask him the right questions, and I just took him at his word. And I looked at his profile online and saw that he was in like private lending and he had this big portfolio. And I had talked to him privately a few times too. And again, I went out to Lubbock and I met him. I stayed with him for a week. And I mean, that's the problem, is like, I don't think he necessarily had really bad intentions or anything, but this is what real estate does, right? It can unravel. And the biggest thing about the Lofty model is he was putting on properties that he probably really needed the money for, but he couldn't really afford to pay the mortgage beyond if they didn't begin performing.
Right.
And that just snowballed, that compounded the issue even more. So I mean, I think, like I said, I think Ario's is great. I think there's other co-owners that can do a good job. I think either there just needs to be more upfront push from Lofty as a platform, or people just really need to be more skeptical and scrutinize. I mean, learn from my mistake. Don't be burned like me. I still think we can hopefully turn it back around a bit more on brownfields, and we are making great progress, but it's like, it was a really, really painful, like I basically had to double the amount of equity to go back in to salvage it and pull it out of the jaws of foreclosure. And it's just been an insane amount of headaches. So I don't think people realize that's probably part of the thing that's been getting to me too, is that people don't realize how intensive it is with some of those property management stuff. Like the amount of phone calls that I have to take, the amount of random notices we get in the mail because the lawn isn't being done by one of the tenants. An HOA tried to foreclose on one of the properties that Austin listed. I was like, I don't even know that could happen. And there's just way more that goes into it that probably need to ask, or just start small. I mean, and I tell people that too, that just start small. Don't trust me. Start with $50. Obviously I didn't follow that, and I mean, look what can happen.
And that you kind of touched on it, but it's something a couple people asked me to ask you about this. For ones that you manage, and maybe you have some investment in them, maybe not a ton. What's your like thought process or motivation where you've just been fronting money for like taxes and expenses and whatnot? It seems like, I mean, property management's already a thankless job, right? And then to just go and why have you been doing that? I'm curious too.
It's a great question. I've really been toning it back. I've really been kind of and this was again the wrong way to do it, but it was when I was in the heat of the moment and all these repair requests were coming in, and it was just like, well, just get them done, right? Like the properties will have the money, just get it done. And like there were scenarios where some of the tenants were taking advantage of me being a new manager and saying all these things like the old, and I felt bad because I was like, there was one, like Kingsville was a great example, that tenant was saying like they had let the sewage like destroy the home for 2 years. But then when I dug in, I was like, well, they renewed the lease back in February and they said that it's been going on for 2 years. So I was like, you had active sewage in your basement and you re-signed another lease with them. So, and then I was like, well, maybe not everyone. And then some other properties, people were doing that too. And I like to give people the benefit of the doubt to start. And as I get more information, I start to crack down back the other direction. So as you know, as I have a better idea, I actually, the repairs and everything are done internally, and I can actually review that. So with properties that had good cash flow and pretty stable tenants, I was more inclined to, and I've really been trying to tone it back and just let it come straight out. But unfortunately, that will kill the yields on a lot of properties, and that's more or less what's happened for a significant number of them.
Right.
But I think it's good in the long run to just start building the escrows now, start building up what's needed for taxes
Yep.
and insurance, really make the platform more like it's supposed to be, with individual insurance policies, proper escrows for taxes, bigger. If you haven't noticed, I've pushed really hard and told every single property to increase their operating reserve, because there's not enough money for what's needed out there.
Yep.
One expense pushes a property into 13% loan from the universal lending down or someone else, and they're never going to be able to pay it off. They don't have it.
Yeah. And one of the things, you're saying like, well, having to do these things is killing the yield, but it's honestly, it's just moving that yield into what the real number is, right? What that property is actually yielding. And that's what I think is a big problem with the platform, is they've created this really ridiculous expectation of what you're going to yield on an average property. And then on top of that, there's a lot of below average properties. And so it is, when you have this, so people are doing whatever they can to just get that cash flow out, versus like, yeah, I 100% agree with you. I think we need really hefty reserves. Like when I don't know if you ever look at Mogul, we've never talked about it, I don't think, but they have really fat reserves on their properties. And I think that's like, if you're going to have this model where, it's supposed to sustain itself, I think that without doing that, you have to just have, co-owners or investors that are really just willing to, to do capital calls. And, I'm fine with that on any of the ones I own. Like if we need to do some stuff for taxes or insurance, yeah, fine. I'd always vote for a capital call, or, whether we do a debt one or a dilutive one. But, so some of the people could just get crazy about that too. They're like, no, we don't want to do a capital call. And so it's like, well, where does that come from? So, luckily for a lot of us, that the answer has been from Alec. And so that's,
yeah. Well, I mean, I'm also pressed on both sides, right? Because like I use Hemlane, and they're helping using their contractors. So
Yep.
when they've already gone out and done that, or they're getting additional quotes, which we've really pressed to do too, to try and get costs down, it's like, well, you've done 3 quotes and the tenant's complaining. And then, a lot of tenants at that point might go to just like withholding rent and stuff like that. Now we're losing even more money from it. And the difficulty for me too is like, do I have to put in a vote every single time across 60 different properties, every single time we needed a capital call and stuff like that? It's just very tedious to keep track of all of that. And I think having the reserves money up front would just serve the properties a lot better. And again, there was a whole discussion today on operating reserves, funds either being mixed up or being sent out in a certain account, and being withheld by Home River Group and Evernest, and all those things are like they hinder a property that could perform maybe better. And to me, another thing you mentioned too is I think you had commented that I move very quickly for things, because that's like, I guess that's what served me well in real estate, is just moving fast on addressing things. And so I guess my default is, if I have the credit line or I have something to push it forward now, pay it now and get the funds back on the back end. And that's probably not the best way to go about it, and that's why I'm trying to tune it better, and trying to get the proper reserves in place, and trying to get I mean, ideally I think Lofty should hand over the whole operating reserve process to
I completely agree with you on
property
that.
managers at this point.
That's been something that, I mean, they've just done a terrible job of like actually tracking it, updating, like usually we have those charts that are like 3 months old and no real explanation from the movements and whatnot. So I completely agree there. One of the things I think, you mentioned moving fast, and this is one of the things that I've seen over and over again. If you're like, for entrepreneurs, moving fast is important, right? So like, as the co-owner and as like the property management side and all that, when you're doing that part of real estate, it's extremely important to be able to move fast, to make deals happen, to do, so I completely understand why that's your bias, right? Like that's the direction, like that's the side you're coming from. From a passive investor side, where it's exactly the opposite, right? Like you want to be like slow, methodical, plodding. Your default should be no, right? Like, and
Yeah.
so it's really rare to find people that are good at both sides, right? And so that's why over time, um, I've really sort of shifted more towards more and more passive investments, and I became much more of a no and looking for that. But I don't think it's when I said that, I don't know what context I mentioned it to you, but like I don't think it's a bad thing. I think it's a bad thing for one aspect of the business, but I think for the other it's very important, right? And that's why it's rare that you see. I mean, normally people sit in one role or the other, right? Like I think as a PM, I'll take you over most of the people that are doing that on our platform or otherwise. And the same thing for going out and making deals happen. But I don't think I would invest in a passive fund with you, right? Where you were like picking investments that other people were doing, because it is like I think you probably assume the best, you assume those people are trying to look out for people the way that you are as an
Yeah.
investor, which is just rarely the case, right? But so
Yeah.
I think it's just like a different strength, and it's not necessarily one is better than the other. I think it just makes you more suited for certain aspects of the business.
All right, we got some questions coming in. I see Hugo tuning in from X. It says, speaking of Ario, how do you feel about the latest governance vote of 317 Solano? You guys have
Was this
any-
the debt move? I don't actually. I'm not even
Yeah,
sure what.
that's the move of the debt for the DAO to take over. I mean, I was opposed to it. Like, I want the debt to be in the DAOs at launch, but when it gets moved into the DAO with no like, so and for anybody who's watching, who if you've made it to this point and you're not in the weeds on Lofty, I'm surprised. But if you're not, the entities just don't. There's a co-owner that brought the property to the platform. That's the person. This is what we were talking about with Alec earlier. That's the person who's normally just paying the debt, and so the entity gets the benefit of levered yield without having to pay the debt. But there's it's just a few times now it's shown that like that's just not really a workable solution for the co-owner, and like that's what Ario came to the DAO and said, look, this is going to cause me a problem, maybe not today, but at some point in the future, I don't know that I'll be able to keep paying this, so I want to move it to the DAO. Well, we're not really getting any benefit from taking over that payment, and it hurts our yield. And so I thought there should be some trade-off, like we should, maybe he pays something towards it. There should be some benefit to the DAO to taking over those payments, right? Because people bought into it with that structure, and then he wants to change the structure. But it is a DAO, so that means there's just governance votes, and he had put out a vote to just basically let him refinance into the DAO. And he's also one of the larger owners, but I think that vote passed with like 76% something, like, which really surprised me because, it's basically you're voting to sort of take on a new obligation with no, we didn't get any new benefit to go with that new obligation. So I was surprised it passed, especially as strong as it did.
There is the benefit of the co-owner no longer gets the equity. So I mean, if you're paying down the loan, you are burning
appreciation. That's true.
So, well, I'm saying in that case, because one of the biggest benefits is if I'm doing a good job. The thing I'm always saying is, and my properties had done very well, is if you're over $50 a token, I'm basically rewarding myself for managing well and keeping it up.
Right.
But some people will say that's incentivizing me to defer maintenance and other things like that, which I could see that being true. But that's why, like, when you remove the wild factor of the loan even being paid by someone else anyways, you can really get a sense of what, is this a good investment? Is it really cash flowing? If you're positively cash flowing on top of that, I think the aim most people go for on single family homes is like, $200 to $400 a door. That's not too bad. I mean, you're not left with a ton left over every month, but there's people trading on that with some operating reserve, and you're constantly setting that extra money aside every month. That's not a horrible situation to be in. And you can be better prepared. Now, again, you might still need to come up with capital for very big expense, but it's better than nothing. It's better than losing money every month.
Yeah, no, and like I said, I mean, I'd like to just see it if they did it at launch, right? Like because one, I don't know if you remember when that property launched. I mean, they were selling for like $60 per token at one point
Yep.
because it had this huge yield
Hmm.
because of the way it was set up, right? And so now I think it's trading at like $36 or so as we pay down the debt in the DAO, we're getting $50 tokens, even though it's currently, so like, yes, there is some benefit, especially if it works out really well in the long run. Yeah, we get the benefit of levered appreciation. I just think it's not a trade-off that I would have been just so willing to take without saying, hey, why don't you give us a little something extra to do it?
I agree. I mean, I think when he listed it too on Solano, he had mentioned about wanting to.
He was
He's like,
going to
"Oh,
pay it
I'm
off.
going to pay it down. Yeah, I intend
Yeah,
to pay it off completely," and that just ultimately didn't. And that's the problem with again, not knowing someone else's full financial information. I don't know the balancing act for that, but
right,
if you just don't have the funds to do it, or you just don't you end up like you're susceptible to the person changing their mind at a later time. Whereas if the property's just paying the debt off the start, that's what it is. And if it needs to be
right.
backfilled, it needs to be backfilled. Or there's a month where you just don't make enough money, you tap into reserves at that point. So yeah, I mean that was, I mean, I'm not gonna lie, on there I bought in very early. The price rode up really high, and then I sold, based off of token price, because I was like, it's gonna come crashing down eventually.
Right.
So as soon as I noticed that he wasn't really paying off the debt, I was like, well, I don't know if I want to stay on the train. So that's why I just kind of took some of the returns, and I obviously ate the fees, but I think that's probably one of the among the better investments I've made on Lofty for sure.
I want to give a shout out to my guy Nick Lead Pray Huddle, who just hit his first 200 subscribers on YouTube. But if you want a lot of
Congrats.
good Bitcoin information, go check him out on YouTube. He's also on X. But he also does mention Alec is sharing a great humble story of learning. We all pay tuition. Could be to investing in Bitcoin, stocks, real estate, or college degree, but the payment to learn will be paid. Yeah.
It's true.
So Troy also has a great question, but he does say, sounds like a good operator could do well doing something like this. But I think this one, this is a good one. So for someone that has no idea what fractional investing is, how can you explain it in a brief 2 minutes? Who wants to take this one on? You?
Um, I can. I mean, with for without intentionally indicting Lofty on getting called a security, it's basically a stock for real estate. It's being able to buy a stock or a share of real estate. Now it's on Lofty, it's tokens, and you're really just, I mean, the easiest way I'd break it down is like, there's a home, and instead of one person buying the home, you're splitting it across 100 people, 1,000 people, 1,000,000 people owning that one home, and you're all technically, not technically, you all are owners, as per the operating agreements and the legal entities, and you all own that together. So it's pretty much taking like a private partnership and expanding it on a more liquid marketplace that allows people to buy in ownership and sell ownership of property.
All right.
And then you
Okay.
get a return on that of some sort.
So Joseph, to add on that, so I think a lot of people in my other group chats, they always think of it as a REIT. So can
Right.
you maybe break it down on what's the difference?
Yeah, and so, and this is why I like fractional real estate a lot more than REITs. It's similar to a REIT if a REIT only owned one property instead of a portfolio of properties. So I get to choose to invest in specific properties. I can do due diligence on that specific property. I'm not just stuck with a blind pool of properties that somebody else is picking. And so that's the big difference between a REIT. Another type of investment that you could think of it as being very similar to is a syndication, but depending on which platform, like on Lofty, the big difference from a syndication and what's going on Lofty is that you don't have the one operator who just gets to call all the shots. We vote on everything. Some of the other platforms, it actually does act a lot more like a syndication, um, where there is an operator, they're doing the work, and we're all basically just, somewhat silent partners. Some of them you have a little bit of voting rights, some of them you don't. But yeah, that's the big difference. And so people, the first thing they jump to is REITs all the time, right? Like, oh, this isn't new. This is just rebranding REITs. And it's like, no, it's completely different because so I started my career. I worked for 2 different public REITs on the acquisition side. And there's just a pressure to buy, and it doesn't, every quarter we have acquisition goals. It does. And if you can't find a deal that makes sense, you still find a deal that you make sense, and so just in going along for that ride versus me actually being able to look at that specific property, does that fit into my portfolio? That's the real benefit of fractional from my perspective, when you compare it to a REIT.
Great answer. Well, we've been going for about an hour. I don't know if there's other things you guys wanted to add on or touch on. Anything else you want to share today, Alec? Or
That's a good question, actually. I mean, I just want to say, well, like I'm in. There's been a lot on the lofty space for the people that are lofty investors. I mean, I still hope that the platform can continue to improve and get better. Or maybe the other thing that's maybe needed is more competition in the space too. That maybe that's something that could help improve it overall. But I'm hoping. I think we're moving to a better spot, at least from a managerial standpoint and operations. So I think that's cool to see. And yeah, I mean, like I said, if you're watching, definitely learn, definitely do due diligence. Listen to Joe when he says do in-depth due diligence. Most people just kind of gloss over and don't think it through. And again, I'm guilty of that at times as well. I like to think that I do more than bare minimum due diligence at times, but sometimes the return, I think the saying is always stands pretty true. Is like if it sounds too good to be true, it likely is, and it's almost always the case.
One other thing I wanted to ask you, and it was really the last question I had on my list anyway. I know you're right now, your finances are pretty tied to Lofty, where you're doing, managing and whatnot. But and if you don't want to answer, it's fine. But have you had any thoughts on saying, okay, these 10 properties, these are the ones I think really make sense. Let me buy these off the platform with a group of investors that I really like working with versus, ones that maybe you think that property makes sense, but it needs a capital call, it needs a different structure, anything. Is that something you've considered, or is that not something that you've thought about?
Yeah, actually, I have on some of them. I don't know how well that would go over with ones that like maybe I've been authorized to actually sell.
Yeah.
And most of those, anyways, I don't think I'd want to. Maybe
Right.
some of the better performing stuff could be. It is hard at times having the I guess having the distance between the things, but I feel like Hemlane does a fairly good job filling in the gaps, and we're giving them constant feedback as a very large client of theirs for ways to continue to improve. So I would definitely be open to that, and I think there's times where that's good. I mean, there's times where I find it very tedious having to just put in a governance vote and everything else. And the funny thing is like the more I've stepped up to manage and do all this stuff, everyone just kind of assumes that I'll do it. So, or if a cost comes up, people just assume that I do it. And the problem with that, I mean, like I said, is that now if I want to pull off, I've seen that people are upset at times, or maybe not, might not like me as much or something, but like I have to consider my own finances, my own business finances and everything first, because if I default, then everyone loses, right? Like all my properties are at risk. Everything's at risk on the platform. If I can't stay solvent and can't keep cash flowing and everything else.
Yeah, well, and that's kind of why I ask, for 2 reasons, right? One, it seems like there's some great, like I really thought about buying Odom when it was up for sale. I had something else cashing out, but it didn't line up well enough for me to actually get that before we sold it. So it seems like there are good opportunities because like we just can't make decisions on stuff, so they just get sold for, in a very imperfect way. But then the other thing too is, yeah, it seems like your level of managing, especially some of them, especially where you're putting cash into it, like it doesn't necessarily seem, it's hard for me from my perspective to think that you're getting the economic benefit you should be on some of these. And that's the other reason I thought, would you just be better off doing that, right? Like saying, okay, these 10 properties, got my little group of investors, we're going to buy them off the platform, we're going to restructure it in a way that Alec gets a lot more say in it. He's also getting a bigger piece of the upside of, if things work out the way that's why I just was curious. I mean, I really want to see Lofty succeed, but every time they come and answer questions about stuff, it creates more and more doubt as if it's going to work long term. So
I mean, I would tend to agree with that, and I say that as someone that they gave me equity in the company too, fully transparent. So I'm rooting for them. Obviously, I'm helping them in an incredible way to put that in the most not arrogant way possible. Am really trying to help them out. And also I just want to say on that too, like I don't think just Lofty's the end game. I mean, now that I've gone through this process, like I have a portfolio of management I can show. And my goal actually was to expand beyond from here. And I was hoping to actually get licensed before the end of the year to be a third party licensed property manager, which in the state of Florida is kind of mixed up with real estate license anyways.
It's the same way in Texas.
Yeah, so I mean, I was thinking just get that done, and then I could show people, here's the portfolio that I already manage all around the country. Some stuff in Florida. I have my local portfolio, the stuff that I listed on Lofty, and just kind of expand the business from there, or continue to pivot into something else. But it was, I guess, if you want to say the biggest help was actually, funny enough, not Lofty itself. It was it was more or less their structure that allowed me to manage without having to have be third party, because I'm an owner manager by owning a token in the property. So that helped me to really jumpstart managing a lot of properties. And then again, from here, I think some of the properties do have potential, really do. I think probably about 50% of the ones I do, maybe 50-75% that remain, have good cash reserves as long as I continue to expand them. And then from there, I could just add on stuff outside of Lofty where at that point I would shift the expenses onto the owner, or it would be an expectation that they would pay it back very quickly, or they have the reserves for that, and I could expand out from there too. So and I have little other things going on where I am, because I trying to get into construction and stuff a little bit down the line. So I have a contact here that I get to offer them to help manage things, and the relationship with Hemlane has really worked out. So that's I don't think it just stops with just Lofty. I think it's I had broader plans beyond just being a manager on there.
Nice.
All right. Maybe we'll wrap it up with this final question. I know Jeff had to jump off, but he's did submit a question. So he said, how do you like Hemlane contracting and repair management?
That is a great question. It is actually, from a you want to be hands-off standpoint, very effective. They do all the direct communication with the tenant for you. They'll call, they'll reach, they're 24/7, so they have someone on at night, which is great because there's been a lot of crazy stuff that has already gone down. So that has been nice to not have my phone going off. Now, if a really big emergency happens, then they do call me because they need approval for stuff. It is nice that you can set the costs. I will say there's been a few things that I think we got charged $315 to replace a lock, and I was like, really is there a way we'd stop that from happening? There have been a number of vendors I've gotten blacklisted off of their contractor list because someone tried to charge like $2,000 to replace a refrigerator, and I was like, $2,000? So I'll say they're great for sticking to licensed and bonded and insured repair and contractors. So I would say typically with that, you're going to pay a bit of a premium since they are more established. They do handle pushing costs down, getting multiple quotes. So that is nice, especially in the larger metros. Especially then there, they have a lot of options. So from that standpoint, it's good. I just think there's a little bit of extra work as managing them and telling them to keep asking for more quotes. But they do handle a lot of it. Like there's no way I would have been able to handle all the repair coordination and maintenance without the team over there doing it. So they do take a lot of the, I guess, like communication burden and scheduling and everything off your plate, which is quite nice. I do think if you're talking like $50 a month, $57 a month, I think it was for that included, is pretty good on a rental, especially if you want to be very hands off. And again, you can get that pricing. I think it's maybe it goes up to $60 a month for if you have one rental or two rentals. So I do there, and again, we're giving constant feedback on that too. I think it's that's good. It's just pricing isn't always great. And again, I think you just have to spend a little extra time working with them to get better pricing on things. But overall, they have a pretty trustworthy group of contractors as far as getting the work done and everything else.
Yeah, absolutely. So I use Hemlane for some of my properties, and there's a lot of people that do use Hemlane in my kind of community. All have the same sentiment. I think they have great customer service, great feedback. I think the one thing you kind of touched on also that a lot of people is if you are in a smaller market, that's going to probably be where some of the issues may come in, as finding vendors and enough people to work on these maintenance issues or requests, right? So I think that's the one challenge some managers may find. But yeah, this is a great episode, Alec. You're always welcome back on. I know Joseph will get you back on. Joseph, anything else you want to wrap us up with this week?
No, I think that's about it. Alec, I really appreciate you, being so open with us. I know, I'm sure this is going to be a year you remember, right? It's a tough year, a lot of transition, but also huge growth for you. So appreciate you being open and coming on here and sharing.
Yeah, of course. It's been 2 years. I mean, I was hurricane last year, now this. So
Oh yeah, yeah.
it's been 2024, 2025 have been a lot of learning, grinding, getting back up and upright. But again, I think we're moving in the right direction. And again, I appreciate you having me on, Mark, and always Joseph too. So talking with you. So thank you both.
Alec, is there anywhere people can reach out to you if they had questions or connect with you?
Willick on the property Discord, and you can also look at my YouTube channel. I'm trying to push out some more content and maybe some more live streams of my own as time permits me more. But my YouTube, I believe, is just my name. It's just Alec Van Beek
All right.
on there if anyone wants to, and I hope to get some
You
some
got
more content
you
out.
want to put it in the private chat, and I can share it in the chat section real quick.
Yeah, sure thing.
You made the same mistake as me, just naming it your name.
Hey, we
At
get
least yours is easier to spell.
Yeah, well, I mean, you'd think that, but I get Alex all the time. I get the capital B in the Van Beek throws people off. Some people add a space, some people don't.
Yeah, that's
So,
Alex Vanderbeek right there.
Yeah. So yeah, I again, I hope to put some more stuff out there. I was pretty good at the beginning of the year, and there's been more business stuff coming up, but I'm hoping to keep sharing that and showing people what you can do and put out some more videos.
I would have liked some live stream from your brownfield trip. That would have been nice,
Well, I have a very good team out there right now, and they won I think almost every eviction yesterday. So
Oh, nice.
we're like D-Day at the property has officially hit, and I think I've been asking them if we can put on some cameras or something, some more. I think we could probably get something good, and that would be a liability protection too, just to make sure that they're covered. But they've been doing a fantastic job moving those forward, and yeah, maybe that's something I can do in the future. Just do a nice little live stream of the whole property as we walk through, or I got a lot of the photos and stuff from the first time and videos, so maybe I tried to upload some of those into the Brownfield Discord, but maybe just share that. I think would do very well. And private road, we have a big plan out there too.
That's the mobile home park.
The mobile home park, yeah, which is a little bit wrapped up on the bankruptcy thing, but I think we're hopefully going to be able to fix that pretty quick. And what was I going to say? Yeah, that we should have the trailers cleared out in the next couple months as well, the ones that are not paying.
Oh, Mark, you're muted now.
Cool. All right. Very cool. We'll get Alec on again. We'll connect his YouTube channel maybe while we're live streaming next time. And everyone else, I said Joseph does have a channel. If you want more daily content on fractional real estate, go check him out over there. Go subscribe. And Joseph, thanks for always getting guests on, putting this together. And I love
thanks
always this
again for having
information.
us.
Yeah.
Yeah.
Everyone, have a great rest of the weekend.